Can you feel the change? The Federal Reserve has just made a decision that could reshape our financial landscape, a 0.5% cut in interest rates. But what does that really mean for you, for businesses, and for the future of the economy? Will it be the relief we've been hoping for, or is there something more under the surface? Stick around because this could affect more than just your savings account or mortgage. Let's dive into what this all means and why this one decision could shape the financial future for all of us. When we talk about cutting rates, it sounds like a good thing, right? Well, in many ways it is, but let's break down how this plays out in reality. Starting with lower borrowing costs. When the Fed cuts interest rates, it becomes cheaper to borrow money. This affects everything from credit cards to mortgages to car loans. But here's the kicker, it's mostly for people with variable rates or those looking to take out new loans. If you've got a fixed-rate mortgage, this cut will impact you directly. It's not going to lower what you owe tomorrow. However, if you're in the market for a new home or car, you might notice a slight reduction in the interest rate you're offered, saving you some money over time. But let's get specific. Credit card interest might go down a bit, which will help if you're carrying debt. That's a small win, but let's not get too excited because credit card rates are still high. So while you might see a decrease, it won't wipe out your interest overnight. It just eases the pain a little. For businesses, this rate cut can be a lifeline. Smaller companies, in particular, are often hit hardest when rates are high because they rely on borrowing to fund expansion or even daily operations. Now, with borrowing costs lower, they can take out loans with less worry about the interest piling up. This could mean more businesses expanding, hiring more workers, and investing in new equipment or technologies. That sounds like good news, doesn't it? But there's always a flip side. Just like with homeowners, businesses with fixed-rate loans aren't going to benefit right away. The effects of this cut will take time to ripple out. It's a win for some, but not everyone will feel the relief immediately. The Federal Reserve didn't cut rates for no reason. There's always a bigger picture to look at. Their two main goals are controlling inflation and keeping unemployment low. It's a tricky balancing act. Let's talk about inflation first. For most of us, inflation feels like this annoying thing that makes everything more expensive, from groceries to gas. After skyrocketing during the pandemic, inflation is finally starting to come down. In fact, it's dropped to about 2.6% from highs of over 5%. That's a big deal because the Fed's goal is to keep inflation around 2%. They're getting closer, but we're not quite there yet. Here's where it gets tricky. While inflation is down overall, shelter costs, which means rent and housing, are still high. If you've been looking to rent or buy a home lately, you probably noticed that. So even though the Fed is making progress on inflation, not all sectors of the economy are feeling that relief equally. It's uneven, and that's why the Fed made this move. The other piece of this puzzle is employment. Job growth has slowed a bit recently, but unemployment remains low. The Fed's job is to make sure that as they manage inflation, they don't accidentally throw too many people out of work. This rate cut is partly about ensuring that the labor market stays healthy and that we don't see a surge in unemployment. But let's be real, this is a gamble. If inflation keeps dropping too fast or the job market cools more than expected, the Fed might have to step in with even more cuts or take drastic action. It's a delicate balance, and we're all part of the equation. Let's shift gears and talk about the long-term impacts of this rate cut, particularly on the housing market and stock market. The Fed's decision has already started to ripple through the housing market. Mortgage rates, which had soared to nearly 8%, have started to inch down. Right now, they're hovering around 6.2%, and they could drop even further. It sounds like good news for potential homebuyers, right? Not so fast. Lower rates might make mortgages a little more affordable, but they could also push home prices higher. Here's why. When mortgage rates drop, more people start looking to buy homes. But the problem is, there's not enough housing inventory to meet that demand. The result? More competition for fewer homes, and that means prices could rise even more. It's a classic case of supply and demand, and it could make things tougher, especially for first-time homebuyers. But there's some good news. Lower interest rates also make it easier for home builders to finance new projects. Over time, that means more houses getting built, which could ease some of the pressure on prices. It's not a quick fix, though. Building homes takes time, and the supply problem won't be solved overnight. The stock market has also reacted to the rate cut. Initially, investors were excited. Stocks rallied as everyone hoped that lower rates would make it easier for companies to borrow and grow. But that excitement didn't last long. The market quickly leveled off, with some sectors seeing gains and others staying flat. Smaller companies, which are more sensitive to financing costs, have seen the most benefit. But for the big players, especially tech giants, this rate cut is more of a shrug than a game changer. So, what does this all mean for your investments? In the short term, it might mean a bump in stock prices for some industries, but don't expect a massive rally. The real effects will be felt over the long haul as companies adjust to the new rate environment. Now let's talk about the risks. Every decision has consequences, and this rate cut is no different. One major risk is that this might not be the last cut. The Fed has hinted that more rate reductions could be coming down the line. While that sounds like good news for borrowers, there's a danger of going too far. If the Fed cuts rates too much too fast, it could cause inflation to spike again. Remember, inflation is like a seesaw, get it out of balance, and things can tip too far in the other direction. There's also the risk that consumers could take on too much debt. Lower interest rates make borrowing cheaper, but they can also encourage people to max out their credit cards or take out loans they might not be able to afford in the long run. If the economy hits a rough patch, we could see a wave of defaults, which would put even more strain on the financial system. Looking ahead, the Fed's goal is to bring inflation closer to 2% and stabilize the job market. But that's going to take time. By the end of 2025, you could see rates drop even further, which would provide more relief for borrowers. But there's a long road between now and then, and a lot could happen along the way. The Fed's 0.5% rate cut is a bold move, but it's just the first step in a longer journey. While it offers immediate relief for some, the full impact won't be felt for months, maybe even years. As we watch this unfold, keep an eye on how borrowing costs, housing prices, and inflation evolve. This is a story that's far from over. If you found this breakdown helpful, please comment below with your thoughts. Share this video with anyone who's interested in what these changes mean for them, and don't forget to subscribe to the channel. Hit that bell icon so you never miss an update on how these financial shifts affect all of us in the real world.